In some ways, the secret to portfolio construction is hidden in plain sight. Markets, whether financial markets, betting markets, art markets, vintage collectibles, nearly any market, when structural and information frictions are minimized, are an efficient way of finding the best thinking. While one can argue that financial markets are not perfectly efficient, the data suggests pretty strongly that they are at least reasonably efficient, meaning that it is statistically unlikely that anyone can consistently outguess the markets, both in where they are going and what stocks are likely to outperform, especially based on hunches. Experts are usually poor at making predictions. It's true in all sorts of realms. Just look at weathermen or your favorite sports team's draft history, but especially in investing. In finance science, we refer to it as the efficient market hypothesis, and it posits that information is incorporated efficiently and nearly immediately in market prices. Talking heads weave compelling narratives, but their ability to predict where the markets are going is poor at best. It's not because they aren't smart or well-educated, it's because it's hard to tell the signal from the noise, and markets don't always behave rationally. They are driven by investor psychology, which is often in flux. So, if we are smarter than others, it's only in the application of humility. We don't believe we have unique insights into what the markets are going to do. We know that no one does. Therefore, rather than paying to try to beat the market, prudent investors seek other means of outperforming the pack. Minimizing fees, minimizing taxes, trying to mirror the market, and optimizing behavior. And the statistics, while not necessarily proving this, certainly strongly support it. While the theory may not be perfectly true, in our estimation, it's a good place to start. And it's where we start with our client portfolios centered on stocks and bonds. We start constructing portfolios around a total market index, and when we choose to deviate from that core philosophy, we think long and hard about it. Our decisions are not based on hunches, but on data, statistics, and probabilities, which is referred to as quantitative finance. That isn't to say that there aren't some pockets of inefficiency in the markets, but they're usually found in small, less crowded corners. They're limited, and they come with their own sets of risks. At the end of the day, investment decisions should be based on probabilities and focused as much on risk as on reward, as those two are opposite sides of the same coin. To engineer returns, one needs to manage risk. And we also realize that there aren't any perfect answers in portfolio management, which is why our clients' portfolios are personalized to their specific circumstances. Their risk tolerance, their prospective liabilities, their incomes, and their estate tax situations, their social and charitable objectives. And as we manage portfolios, we continue to incorporate those criteria. If you are interested in how our process and data-driven approach could help you, contact us. We'd be happy to talk with you.